This market is insane. I recently discussed my performance and then everyone is commenting like, you're also spending hundreds of hours researching and working on it. Index funds are invest and forget. Simple, time is valuable. Another comment here, you beat the market but you had to devote large amounts of time and effort in order to do that. You could have just bought the S&P 500 and gone on vacation. Are we crazy? Are we insane? The market has gone too overconfident. If you look at, since I compared my performance with the market has gone nothing but up, done 14.3% per year, as I discussed in my video. With work, I did 14.5, but I could have gone on vacation, I could have just invested in the market and forget about it. However, when it comes to investing, I think that people are now so overconfident and they are seeing just this. Nobody is seeing this. If we eliminate the last 15, 16 years, peak bubble 2000 to bottom 2009, the stock market was minus 57%. Minus 57%. And given the exuberance that we are now, the overconfidence similar to the peak of the 2000 dot-com bubble, it's very likely that what I'm showing here on this chart, that side of the chart, is likely to happen again, can potentially happen again in the next decade. But I am crazy and Wall Street is projecting the S&P 500 earnings to double in 2 years. From the current real earnings of 200, earnings will hit 310 on AI, on who knows what. Everything is so great. The government will keep on spending 2 billion extra. The deficits will just keep on traveling at 7%. The economy will just keep on growing. Nothing can stop this market. And stocks will only go up, valuations don't matter, but again, everyone has confirmation bias because they are forgetting to look a little bit deeper into history. And if I go to the current S&P 500 P ratio, the median is 15 from the current 30. That means that if it just goes back to historical averages, that's minus 50%. Just from P ratios going down, all else equal. If I smoothen things out a little bit and I go to the Shiller P ratio that takes into account 10 years of earnings, we are here. This was the dot-com bubble, this was the 60s Nifty 50 bubble, and this was the 1920s roaring mania. Do I need to show you what happened then at these valuations? Well, let me show you. 86% decline after the 1920s, 76% decline after the 1960s, 60% decline, this is with inflation, real returns after 2000. And now things are different, stocks will just keep going up, they will never return to the mean. Dividend yields, if I look at the current S&P 500 dividend yield, if it goes back to the mean, that's 75% down just on interest rates. And the dividend yield now is remaining high despite the fact that the US 10-year Treasury is not at 0 or 1% anymore. Now it's 4.5. So stocks haven't adjusted to interest rates, because if stocks adjust to the 10-year Treasury, then you are expecting a 15p ratio from stocks. That would be then normal, which is again 50% down. This is insane that the dividend yield on the S&P 500 is 1.2 and the Treasury, 10-year Treasury, is giving 4.5. And a 50% downturn scenario would be a positive one actually, because if this reverts to normality, that's 50% down. If then there is panic, then that is even more, a recession, things like that. All I can say to all these overconfident comments is good luck. I cannot change your mind. You are enjoying the best bull market run in history. That's it. What can I do about it? I'll keep doing my thing. I hope your thing keeps on working.